Markets often turn their spotlight on flashy tech names, but some of the most compelling opportunities right now can be found in the companies that keep the world running, those in basic materials and industrials. Today, we'll explore 3 businesses that top analysts are backing with strong buy ratings. These aren't just background players, they're leaders in chemicals, construction, and power management, and they're all positioned to benefit from global demand shifts. Stock number 1, Methanex, MEOH. Our first stop is Methanex, the world's largest producer and distributor of methanol. At around $39 a share, the stock has slipped about 8% over the past year, but it has regained momentum with a 12% climb in just the last 3 months. Methanol might not sound exciting, but it's an essential building block for countless industries, used in making formaldehyde, acetic acid, fuels, and even construction materials. What makes Methanex particularly relevant today is its positioning as a provider of cleaner burning fuels. As industries push toward decarbonization, methanol is gaining traction as a viable alternative for shipping, heating, and even some transportation uses. In their most recent quarter, the company delivered earnings per share of 96 cents, well above expectations, though revenue came in slightly below forecasts at $797 million. Beyond the numbers, Methanex successfully closed its acquisition of OCI's methanol business, adding 2 large-scale production facilities in Texas. With that move, the company is targeting 8 million tons of annual equity production by 2025. Analysts at RBC Capital recently upgraded the stock to a buy, pointing to improved visibility thanks to the OCI deal, supportive U.S. trade policies, and steady methanol demand. At historical pricing, Methanex could generate roughly $1 billion in adjusted EBITDA annually, translating to a strong free cash flow yield. With 8 analysts unanimously rating the stock a strong buy and an average price target just under $50, there's an estimated 26% upside from here. Stock number 2, CRH, CR. Next is CRH, one of the world's largest building materials companies. Based in Ireland but with a global footprint, CRH trades at about $112 a share. Over the past year, it's climbed 20%, and in just the past 3 months, it's gained another 22%. CRH supplies everything from asphalt and cement to aggregates and value-added construction solutions. Its products are critical for transportation systems, infrastructure, and commercial building projects. The company also stands out for its focus on sustainability, consistently ranking among sector leaders in ESG ratings. In its latest quarter, CRH reported earnings of $1.94 per share and revenue of $10.2 billion, a 6% increase from the year before. The company has been active on the acquisition front, investing about $1.7 billion across 19 deals, and raised its 2025 guidance for adjusted EBITDA to a range of $7.50 to $7.7 billion. JP Morgan analysts reinstated coverage with a buy rating, citing CRH's broad geographic reach, proven record of bolt-on acquisitions, and strong cash flow generation. They note that despite its size, the stock trades at a discount compared to peers. Looking forward, possible inclusion in the S&P 500 and continued share repurchases could serve as meaningful catalysts. Analysts overwhelmingly agree, with 15 out of 17 rating the stock a buy, and the consensus price target of $125 suggests about an 11% upside. Stock number 3, Eaton, ETN. Finally, we have Eaton, a global leader in intelligent power management. Trading at $362 per share, Eaton has gained 11% over the past year, with a modest 3% uptick in the last 3 months. Though headquartered in Dublin, Eaton operates in more than 160 countries, providing systems and services that help customers use electrical, hydraulic, and mechanical power more efficiently. Its offerings are vital to industries looking to operate more reliably, safely, and sustainably. In the second quarter, Eaton reported record results, earnings per share of $2.95 and revenue of $7 billion, with 8% organic sales growth. One standout was their data center business, where orders jumped 55% as demand for cloud infrastructure and AI-related capacity surged. The company also raised its outlook heading into 2025. Analysts at Melius Research recently upgraded Eaton to a buy, noting that concerns about valuation have eased and that the surge in AI-related capital spending should keep demand strong. They believe that supply will continue to trail demand in the near term, even with added capacity. Currently, Eaton holds a strong buy consensus from 16 analysts, with an average price target of $398. That implies a 10% gain, with the most bullish projections pointing to nearly 37% upside. These three names, Methanex, CRH, and Eaton, may not carry the buzz of tech stocks, but they are cornerstones of global industry. Methanex is riding the shift toward cleaner fuels, CRH is benefiting from infrastructure demand and smart acquisitions, and Eaton is tapping into the explosive growth of data centers and energy efficiency. Strong buy ratings across the board suggest confidence from analysts, but as always, investors should weigh these insights against their own strategies and risk tolerance. The industrial and materials sectors may not be glamorous, but they're essential, and sometimes, essential businesses are the ones with the most resilient opportunities. Thanks for tuning in, and here's to making informed, long-term decisions in your investing journey.